view what we've done tonight. So I've got that going. I thought we'd start by looking at our little book. And this is our last week in it. We're pretty much going to do the first 5 chapters. But so that you don't feel like it's a waste, it continues with you in Finance 351. So we're going to do some and they're going to do some. And one of the things I wanted to look at was to go to, I think it's page 21, where it first shows you a balance sheet. And kind of give you a little discussion of balance sheets. I know you've already had a week in it, so I don't want to insult that you don't know anything, but just making sure I've covered all the bases. Assets are the things the company, fumble fingers tonight, what they own. Liabilities are what the company owes. And a couple caveats to this. When we say that it's things that the business owns, it can't be renting. They literally have to be buying it. So if the company doesn't have their own building, but they lease some space in a building, that would not be listed as one of the assets on the balance sheet. We're only going to list the things that they are purchasing or owning. But it's okay to have a mortgage. So, yes.
What about like land contract? If you say buy a farm on land contract.
Right. There's generally very, very specific rules to figure out if they can consider it an asset or not. Generally, the way land contracts are written, it would fall in the asset category. But that's kind of an intermediate accounting thing. And I don't mind you asking the question. I just want you to realize that, the level your book's going to be explaining, they're going to kind of gloss over that. You're either buying or you're renting and not try to get in the gray area. It all comes down to what rights do you have? Are you, in essence, the purchaser? Or do you have more rights as if you're a renter? What's going to happen at the end of the contract, like a lease? Will it become yours, or does it revert to the original owner? So I would say a land contract is going to fall very much like a mortgage and be treated that way.
Okay.
But there'd be a few things that if it had certain clauses in it that might make them think of it more like rent.
Okay. Thank you.
Rent can be considered a liability?
A mortgage is a liability, but what I'm trying to say is that you don't have to own it free and clear. You can still be in debt and still paying it off. So the vehicles, the building, and so on can be listed here, and yet you still are making payments. You haven't paid it off.
Would rent be considered a liability, though, because you owe each month?
Oh, generally it's considered an expense. The things that would go in a liability are the unpaid bills. Imagine an inbox that every time you open the mail, find another bill, you throw it in the inbox. You keep go way back in time, but it used to be long ago, you got a mortgage, you get a little coupon book, and you ripped off a little coupon and you sent it in with your payment. That represented the whole mortgage. When you got to the end of all those coupons, you had that thing paid off. Okay. So you imagine throwing that coupon booklet in the in basket too. That really represents all your liabilities. What, as of today, you're indebted for. Even though you know next month you'll have a rent payment and the month after that, you have no legal standing in terms of owing it right now. You will in the future. If for some reason you got behind in your rent, and here it's April 15th, and you haven't paid your April rent, then it would be listed as a liability. Okay. But knowing that you owe in 2 weeks for May 1st, it won't go on here. That seems okay?
Yeah.
Okay. Same thing with utility bills. If you got one sitting in the in basket that hasn't been paid, but you have used up or consumed the electricity, that it's going to go on this list.
Okay.
So some of the things they talked about in the asset category, cash, that's in our English language and in just common use, we think of it as the coins and bills that we have. Do you have any cash on you? It's a common conversation between my husband and I, especially when the kids need something, a few dollars to go here or there. But in the accounting language, they're meaning the checking account, the savings account, all the liquid cash that the company has. So when you see cash, they're talking about all liquid assets. And then almost liquid would be the marketable securities. These are the things you could get out of by calling your broker and getting your money out of it in a few hours. Something that you can liquidate quickly. Contrast that with investments, which is down on line 6 on that same balance sheet. The investments listed there are the longer term things. A piece of property we bought as an investment. Some stock in some other company that we bought and we plan to hold for a very long time. A bond. So it's just more the intent of the item that we bought as an investment, whether it's something short term we can market or sell real quickly. It puts it up here in line 2 because it's so close to cash. Accounts receivable, the customers who owe us money. If we do our service or we sell our product and we allow the customers some time to pay us, then we are going to have accounts that we're waiting to receive the money from, or customers who are waiting to receive money from. Some companies won't have that. If they're straight up a cash business or Visa and credit cards can be used, customers walk in, buy a product, and they pay us either with their credit card or with cash, we'll never have accounts receivable. So we'll never wait for someone to pay us. But most companies that we'll be looking at, the larger companies, will have some form of receivables. Usually real short term, give the people 30 days from the statement date to pay us. You will also see that they will have below it, they may have titled it a little different, but they will subtract an amount of money out of their receivables for the ones they don't think they'll collect. They may have no idea at this point who won't pay, but they have pretty good idea, given past history, that if you have receivables, a certain percentage of them are never going to get paid. So they're telling the reader of their balance sheet, legally I'm owed this amount of money, but I have a certain percentage of it that's never going to come in if things hold true to the patterns of the past. So don't be surprised if you see something like that. And sometimes instead of showing both lines, they'll just say accounts receivable and they'll put the parenthesis net. That means this is the subtotal after I have taken away what I think is uncollectible. This would be called the net realizable value of accounts receivable, what I really expect to get out of the receivables. And then inventory, the products that we're going to resell. We buy them from some wholesaler, slap a price tag on it, and sell it in their store. The value that's put down here for them is the cost it cost us to buy that item. So last night in class, I'm teaching this exact same class in seat, and our first night was last night. We talked about a little kids running a snack stand at the soccer game. They went to Sam's Club, bought some snacks, ran the little table, and sold everything for $1. And we used the scenario that when they went to Sam's Club, it cost them 60 cents for each of those snack items. So they would have their inventory as 60 cents a piece for as many as they have. That will be put down not at the price we're going to charge for them, but at the price we paid when we stocked up. Making sense? Okay. This first group of assets are called current assets. And there are a few more that could possibly go in there. But current assets are the ones that are going to be turned into cash or turned into cash or used up within a year. 12 months is kind of our criteria for something to fall on current assets. Cash is already in cash form. Marketable securities can be liquidated or turned into cash really quickly. Accounts receivable, we sure hope we'll get the money. If we give them 30 days to pay, we should have all the money by 12 months. And of course, new customers will come in by then, but each item should be liquidated, and hopefully our inventory turns over fast. The next section is just the one item, and this will come and go. Some of your companies you'll find an investment on. I managed to do the whole column in yellow. Isn't that nice? Here we go. Investments, if they have long-term investments, they'll be listed. If the company doesn't have any, they'll just skip right over that line. They won't even show the heading or name for investments. So don't be surprised if you're looking at balance sheets and you don't see it. And then you'll have a fixed. One of those kind of nights. Oh, I must have hit caps lock. That's what it is. Fixed assets, and that's a heading. Just letting you know that the things after this are long-term assets. The other criteria is that they're tangible. So this is where they would have their vehicles, their buildings, equipment, tangible items they use in the business that they're going to keep more than a year. So that would contrast them with things up in this current asset category. They're also recorded at cost, but then underneath them, you will see something that says less accumulated depreciation. So for example, we have a $40,000 vehicle, and that's the cost we paid for it when we bought it. We can't just keep reporting on the balance sheet, I have a $40,000 vehicle. That'd be misleading our readers, overstating the size of our business. It would just not be good practices to inflate the value. What we do instead is take the cost of what our asset is, divide it over how long we're going to keep the asset, and every time knock it down a little in value. So if we've had it a few years, we'll have racked up some depreciation. I'll move this over so I can get a little more space. And let's say we've depreciated it so far by $10,000. Then our asset will be shown on the balance sheet as a $30,000 asset. That would be called the book value of the asset. You would tell the reader the original cost, but you'd also show that you have been depreciating it. So right now it's on the books for $30,000. Next balance sheet will be a little less than $30,000, and it'll keep going down. Tristan, feel free to jump in.
So just for the accumulation of depreciation, it's just, so in the second year you said it'll be a little less, so it'll be
this value will be a little less. So let's say in 2000,
10,000 each time, but it's 30,000 minus the 10,000 for the second year.
So
yes?
Let's say the vehicles were 40,000. It's been depreciated maybe 2 years now.
Okay.
So next year this will be up to 15,000, and the subtotal will be at 25.
Okay. I was just trying to think of how to put that on, like, say, the balance sheet, or how to figure out all this. Okay. Thank you.
Are you thinking about the chapter 1-2 homework?
Yeah.
Yeah, we'll be looking at the depreciation methods, because there's a couple methods in which to do it. So we're going to talk about those. Same thing with the building and the equipment. They'll each get depreciated, and they'll either be shown with their depreciation on the next line, or they'll be shown net with just the subtotal. If they do show it net, there's generally a little asterisk or some kind of footnote where it sends you to a supplement to the balance sheet. that explains the whole thing in paragraph form. This building originally cost, we've been depreciating it this long. That's why the subtotal you see on the balance sheet is whatever the number is. You want to tell the reader in some form the original cost and the amount of the depreciation, whether you do it right on the balance sheet or you subtotal and send them to read a paragraph later. So then the assets get totaled just like they do in page 21. And in page 21, their total was $3,202,000 for their total assets. That's all current investments, fixed assets, everything all together. And then they started talking about their liabilities. And I'll stretch these over here. The liabilities are the things that they owe, and they owe as of today. So they would have accounts payable, which is actually a collection of lots of little bills. It's like grabbing that inbox that we talked about where all the mail is sitting, and you've got a receipt from the utility company or a bill from the utility company. You've got the credit card statement. All those things lumped together are called accounts payable. The reason we don't list each one individually is because it could be a really long list, and the person using the balance sheet probably doesn't need that level of detail. They want to know how big our debts are, but unless they're the manager in charge of that section or in charge of making sure the payments get out correctly, they probably don't need to know each individual bill. So for the reader, accounts payable suffices for the collection of small bills. Then you'll get something like notes payable. The book calls it bank notes. Either way is fine. It means that we've signed a promissory note with a bank. That might be to buy a vehicle. It could be another type of loan. Anything that involves an actual signature on a note. The other things that we've talked about in accounts payable are more informal. We call our supplier and ask them to send us another case of something. They send it to us, give us 30 days to pay, and we send the money back to them. That would fall in accounts payable. Notes payable is the more formal, buying a piece of equipment on time, buying a vehicle, and signing a note. And then they have an other. But these are the two that can be in the current liability section. And just like with current assets, current liabilities are things that are going to be paid within a year. So they're the short-term debts. And if there's a lot of long-term debts, you would list them all. But page 21 just took the shortcut and said, we have a long-term liability. That's probably the mortgage. It could be a vehicle loan. It's anything that has a balance that you're going to pay more than a year from now. You will sometimes see a mortgage or another long-term debt split into two places. The current portion of the long-term debt, in other words, the total of the next 12 payments that I'm going to make, how much of the balance is going to be paid in the next year? And then down here would be the remainder. So while it's one debt, you're reporting it in two places. People are going to analyze that balance sheet and try to look at, oh, in the next year I've got all these debts I've got to pay. And if they left the whole chunk of that long-term debt that was going to come due in the next year, if they left it off and just reported it down with the rest of that mortgage, it might mislead the reader into thinking there's not many debts to deal with in the next year. And of course, this doesn't recognize the recurring ones like we talked about. Jennifer asked about the rent. The rent isn't going to be listed here unless there's that part of it that we haven't paid. There's still lots of other ongoing things that would be included, but these are the debts we have at the current moment that are going to come due in the next year. Liabilities get totaled up also. So I'll just write down what our book had. Total liabilities they had for us were $1,198,000. And if we take a look at the accounting equation, take the assets and you minus the liabilities and find out if there's anything left over. Fancy word in accounting for leftover is equity. A lot of us do this when we're talking about our house. We look at the value of the house, what our mortgage balance is, and say, oh, we have some equity. It's the same way with the company, except they're looking at all their assets and all their liabilities, not just the one particular building. So for our company, this is their assets and their liabilities, and I'm making it negative so I can subtract it here. And our leftovers would be just over $2 million. If this was a sole proprietorship, that $2 million would belong to the owner. We would say that the owner could take the business, liquidate the assets, pay off the debts, and the money left over would belong to the owner. If it's a partnership, it's going to be shared amongst the partners in whatever arrangement they've made. In a corporation, this belongs to the stockholders. In our particular example on page 21, there are two kinds of stockholders, preferred and common stockholders. We have a stockholders' equity section, lists both kinds of stock. The amounts listed for both of these represent the money paid in by the stockholders. So this business, according to the 2011 balance sheet, $150,000 came in from preferred stockholders, $497,000 came in from common stockholders. So together you're looking at about $640,000 of the equity of the business was contributed when those people bought stock into our business. That's how we financed some of the operation of our business. We asked them to buy stock. They gave us money. We took that money and bought things and started running our business. The only yeah, go ahead.
Can you repeat the difference between preferred and common stock holders one more time?
I actually didn't talk about it.
Oh,
so
sorry.
A good question. It's okay. Preferred and common. If a company only has one kind of stock, it's common.
Okay.
Corporations have to have common stock. They can have a second type called preferred stock. Preferred stockholders get preference. In that scenario, when the company was liquidating, they sold all the assets, paid off their liabilities, and had money left over, the preferred would be first in line to receive their share of that. They're preferred when it comes to a lot of the situations. If the company can only afford to pay a small amount in dividends, preferred are first in line. You pay them first, money left over goes to common. Okay. But on the flip side, common are the ones that can vote. Preferred shareholders get no vote in the company. So these people have the power to make decisions in the business. Yes, there's tons of common stock. So if you own one share of a company that has 1 million shares of common stock out there, you really don't have a big voice in the business. But a group of stockholders or a big owner could have a lot of influence. Preferred stockholders have no voice. They get into buying the preferred stock because it's a little safer investment. The company, it's almost like a liability to the company. They need to really keep the preferred stockholders happy, pay their consistent dividends to the preferred stockholders. But by taking on more preferred stockholders, they are not opening the business to more people having a voice and a say. You can imagine the more voices you let in, the more confusing the things are going to be and power struggles and stuff. So this is a nice way to not let in any voices, but to still bring money into the business. So these two show us the money paid in, and the last stockholders' equity account is called retained earnings. Earnings or profits the company has held on to or retained. So the amount here is prior profits, all the past years just keep dumping into this account, minus any dividends that were paid out. So when the company pays dividends, they're taken out of this equity account. So when we look at page 21 in the balance sheet they've got there, they have $1,357,000 of retained earnings. They have obviously had some profits in the past that have led to it having that nice pile of equity. But I'm sure the profits of the past, if I took every year they've been in business and added them up, it would be a lot larger than that amount, because they would have paid dividends every year also, or at least most of the years. But together, these three accounts are going to make up that stockholders' equity balance. The accounting equation that we showed here can also be written one other way. Several other ways, but this is the most common way you're going to see it. Assets equal liabilities plus equity, I'll call it. Stockholders' equity, owner's equity, depending on type of company. That's the way the balance sheet represents it. They list the assets, total them, and show that they make over $3 million. They show the liabilities and equity, total those together, and show that they make $3 million also. Just to kind of show you the accounting equation is always in balance. As they record day-to-day transactions, they're always keeping that equation in balance. Because every one of the numbers that we're looking at on page 21 is going to change over time. Cash changes all the time. You think about your own personal checking account or savings account, the transactions flow in and out there probably several a day. So you have to, when you make a balance sheet, just pick a moment in time and list these things as they were at that moment. Even though in an hour, a day, a week, they're going to be a different number. So a balance sheet never talks about this is the numbers I had for the month of April. It would be these are the numbers on April 30th. So balance sheets for a moment in time. An income statement, however, is going to look at a period of time. But before we get into an income statement, I'm trying to decide whether to look one thing or the other. I think I'm going to take you over to look at the homework. So give me a second. I'm going to share the screen to another window. And hopefully this looks a little familiar if you've downloaded it out of Unit 2. It's just a Word document. It tells you what you need to do. You need to classify. You can type right in the Word document and then upload it again. Lots of different questions. The first one just asks you to go through and decide what category each one of these things would fall in. Some of the things we just talked about will help you do that. Think about, is it something the company owns? It's an asset. Something they owe, a liability. Or we talked about the three accounts that would make up stockholders' equity. Preferred and common stock and retained earnings. And that should get you through filling those out. Number 2, A and B, use that accounting equation. We just talked about how assets have to equal liabilities and stockholders' equity together. So using the accounting equation, you can solve for the one out of the three that's missing in each case. Raquel, are you able to hear me okay? Tristan and Jennifer, I see your faces, so I kind of know you're with me and you're nodding and so on, but I worry because I can't see her face and I'm not getting auditory feedback.
Yeah. I can hear you guys.
Great. Still not able to see, though? Okay. A and B, feeling pretty comfortable with in question 1? Okay. C is going to take a little more thinking about. Be real careful on the dates. Some of these dates are for January, some are the end of the year. So we're talking 12 months apart. I'm going to cut back to my Excel for a minute and show you how to set something like that up. I would make one line for beginning of the year, one for during the year, and one for the end of the year. Then I would make my accounting equation. I'm leaving off the pluses and the equals and the minuses, but we're going to be filling in the information they gave us. So if they gave us beginning of the year assets, I'd put it here. And then they'd say they went up by 50,000 this year. Then I would type 50,000 in here. And then I could figure the ending, because if they gave me the beginning, they gave me the during, I can find the end. In each of the cases, you're only going to get 1 or 2 items from each line, but they'll give you enough that you can go and fill in all 9 boxes. That makes sense?
Makes more sense now. I did it on my own, and I think I got it, but that makes a lot more sense.
Be careful in what they're asking for. Sometimes you can do all of this, get all the numbers right. In this case, it's not so bad, but if this had been a test question and it asked what was the end of year equity, and you answered equity went up by 50,000, well, that wasn't the question. The question was, what was it at the end? So I always warn students to make sure you read not only what they give you, but what do they want you to find. And that works with every question that you're given. And I'll be sending you the file, so don't worry about formatting. This is just the other tab at the bottom. And we're going to go back and look at the homework again. 3 is a whole lot like number 1. Same accounts, except now classify them. Property, plant, and equipment is another way of saying fixed assets. So it's going to go in one of those 4 categories, or it's going to be a stockholder's equity account, and thus not an asset or a liability. So just put letters A, B, C, D, E, or write out next to it current asset. You can come up with your own abbreviations for them. PP and E is a real common one for property, plant, and equipment. Just something enough so I could follow along with what you're doing. Now, the things I wanted to get into before we got into the income statement. Companies will look at their accounts receivable. You have to figure out what percent or what amount they don't think they're going to collect. So the company has $460,000 of accounts receivable, but it knows, given past history, that part of that's not going to come in. The uncollectible part's going to be about 1.5%. What they're asking you for is the net realizable value, which is a fancy way of saying, how much do we really think we're going to collect? So just work the math to figure out what they do expect to collect. That makes sense?
Yeah, I'm not awesome with numbers, but so I would just say 460,000 minus 1.5%. That's what I expect to collect, correct?
Yeah. And
right.
1% is knocking 2 zeros off the end of a number.
Right.
So go up there to 460,000, knocking a couple zeros off. I got 4,600. So it's going to be more than 4,600, but it's not going to be some astronomical number, and it's not going to be 400. It's going to be a chunk more than 4,600. So that kind of helps me ballpark whenever I'm playing with decimals and worried about doing the percentages wrong. I try to do, okay, what's 1%? 10% is knocking 1 0 off. That would be 46,000. So now I'm somewhere between and probably pretty close to 1%. The other thing that companies need to do is figure out their ending inventory. We saw inventory on our sample balance sheet. They just gave us a number. But the reality is that the company has to keep track of how many products they have, how many they're selling. So at the end of the year or month, they know how many they got left. So if you follow this story, our company started with 100 products at $10 each. That $10 is how much we paid for them when we bought them. Then they kept restocking. So this is just a list of every time they restocked. And their supplier wasn't nice to them. To make the demonstration of how this is used, I made the prices go up considerably. Every time they went back to their supplier to restock, the price had gone up. So they have a lot of products, 100 plus 200 plus 300 and so on, that they've processed through their company during the year. But at the end of the year, only 400 products remain. So we need to figure out how many they must have sold. Best thing to do is figure out, first of all, how many we had. We had 100 in the beginning, then we added another 5, 7, 8, 9, 10, 11, 12. We added another 1,200. So we had 100, we added 1,200 more by buying more. We had 1,300 products that came through our business this year. They looked on the shelf and only found 400 left. So we must have sold 900. Doing okay with that?
Yep.
Kind of logic? Okay, I'm going to go back to Excel. I know you've got the math on it. If someone can keep this, does anybody happen to have that open or handy?
I tried, but I couldn't get them.
You
I'm
mean
going to put this on my side screen so I can keep looking at it and grab numbers from it for a couple minutes and then look at our Excel at the same time. Okay. Something I wanted to show you was a diagram you're going to see me use a lot. Bear with me as I use the not so great drawing tools of Excel, but they'll do what we need to do. We're going to make a 5-box diagram. First box is always beginning inventory. Beginning, how many we had in the beginning. And we had 400 products. 100 in the beginning. And the next one is how many more we added in. In this case, how many more did we purchase? And that was 1,200 more. And I'm going to shrink this down so that hopefully I can fit more stuff on the screen and let you keep seeing. And I'm going to make a center box. It's going to be as centered as it can be. And this is like a subtotal. So it would be the top 2 boxes added together. And then the bottom 2 boxes are going to explain where these products went to. These are the ones that are still here. And they told us there are 400 still here. Now, other box is the opposite of still here. Gone, or in this case, sold. So using our 5 boxes, the top 2 have to add together to equal the center, and the 2 bottom ones are going to do the exact same thing. They need to add together to make the middle box. So that's how I can figure out that 900 were sold. The 2 bottom boxes add up to the middle, the 2 top add up to the middle. That feel okay? I mean, we were able to work the problem out without that, but we are going to use that in so many instances as we move through, especially the next textbook, that it's nice to start getting used to the 5 boxes now and then just keep implementing them as we're going. I'm going to add dollar amounts to this. Our beginning inventory was 100 products that we said cost us $10 each. So we have 100 times 10. And I took what I hit. What did I manage to do? Aha, I took off my number. There you go. So we had $1,000 of inventory in the beginning. We purchased all those additional ones. The January one was 200 more products at $11 each, then 300 at $12. If I took the grand total of all the money it cost me to buy those items, that's what I would put here. And I don't happen to have it, so I'm going to type it in here. 2,200 plus 3,600 plus 3,250. 1,400, 3,000, and 2,400. So that's a grand total of over $15,000 spent to buy what I bought this year. So combining those together, I can find the subtotal of how much dollar amount of inventory I had throughout the year. So I'm going to go add those two numbers together. And I have over $16,000 of inventory to account for. 400 of it's still here. 900 of it was sold. The question is, did the $10 ones get sold? Or are they part of the 400 that are still here? What about the $11 products? Or the ones that I bought close to the end of the year at $16 a piece? Have they left, or are they still here? It becomes a tangled web of trying to figure out which ones are which. Companies have to choose some way, unless they've got some kind of barcoding system where they can actually track them. Most of them are just going to make an assumption. The most common assumption is first in, first out, abbreviated FIFO. It means that we're going to assume that beginning inventory that we've had since the year began was the first stuff we sold. And if we have anything left, it's the most recently purchased things. So if we were to go through our list of all the products we had to sell, all 1,300 of them, and figure out which ones are sold and which ones are, I'm looking down a little farther, still here, we would start with the beginning inventory and say, oh, the 100 at $10 a piece, those guys must have been sold. If we sold anything, we sold them. But that's only 100, and we sold 900 products. Then I go to the next layer and say I sold all 200 of the next layer that were $11 a piece. And I keep doing that until I reach 900 products. And then I grand total the sold area. Then I would start with what's still here. Everything I didn't put up here and sold, I would list here. And come up with a grand total. And they call that ending inventory. Inventory at the end of the period. And then you put your two amounts here. So our sold, we're going to go there. And our ending inventory is going to come over here. But together, they should add back up to 16,850 because all our products are one or the other.
So, Donna, I have a quick question.
Sure.
Can you hear me?
Yes.
Now, are you looking for, when we turn our homework in, do you want to see this or do you just want the answers?
Just the answers, but showing me a little math wouldn't hurt, because if you make a simple math error and all I see is she put down a dollar amount and I don't know where she got this number and it's not right, then I can't do partial points.
Okay.
So you don't have to do anything fancy. You don't have to draw boxes or anything, but showing me how you arrived at numbers will really help.
Got it. Okay.
Does this kind of make some sense so far, folks?
Yeah, that whole thing where they subtotal is really good.
Okay. The opposite of FIFO is LIFO. LIFO is going to do the exact same thing in terms of deciding what's sold and what's here, except they're going to start with the most recently purchased. And that's kind of a weird thing to picture. I think we all can picture FIFO happening in a store, especially in the dairy department or something. They're going to want to sell us the old milk first, so they're not stuck with that in inventory. The best analogy I've seen for the selling of something LIFO is like a gravel yard or a place that sells sand and grades of peat moss and topsoil and so on. You go in, they have these cement slabs, they have a huge mound of whatever product, and if you want 6 yards of it, you go in, they scoop it off the top, throw it in a dump truck, and deliver it to you. If they get restocked, they have a huge dump truck that comes in and refills their big mound. And the first customer that comes in after that is going to get right off the top of the pile, the freshest stuff that was delivered. It doesn't matter when you're talking about gravel and peat moss and so on. No one cares how old it is. So the physical flow of goods, LIFO, would probably be for anything that was not perishable or running the chance of becoming obsolete. But when they do it accounting-wise, the goods can actually be selling FIFO in a normal flow of the most recently, or the oldest stuff sold first and so on. But they can keep their records or decide how much money gets put in these two boxes. They can do it LIFO. So a company can choose which one to use, and it doesn't have to match the way the products are literally leaving the business. So you'll see a lot of companies will do LIFO. So all you've got to do is find the 900 again, but this time starting from the bottom and selling from the 16 all the way up until you reach 900 products, and having the ending inventory be the products that are oldest. The bottom of the slab of peat moss. That stuff's never going to sell until they get so low that they have to scrape the bottom of the cement pad. So you're going to have two different numbers for ending inventory and two different numbers for cost of goods sold. You'll have it once for FIFO, a number for each box, and then for LIFO, you'll have a number for each box. Doing okay?
Yeah.
Good. I think that's enough on that spreadsheet.
I know this is making us learn how to do everything by hand, but it seems like there'd be a finance formula on Excel to do all this.
There probably is. The trouble is sometimes doing them gives you an understanding of how all the numbers are manipulating.
Right.
Get a formula to do it. It's just, I don't know what it does, but I put it in and it comes out. Kind of the same argument. Your kids are little, Mommy, why do I have to learn multiplication? The calculator will do it for me. If you want them to understand what's really happening with the multiplication. Yeah, you'll tell them the news later that those long division things they cried over in fourth grade, they're never going to have to do again, and no human being sits and does long division for fun or at their job every day. Yeah, we have fun things like Excel and a calculator, but I wouldn't want them to not know it either. So, I am going to run back over to our homework here. You should be seeing the homework question 6. If this has shared the right screen with you.
Yeah.
Talking about our asset, a long-term asset that needs to be depreciated. Some of the things you're going to be told are how much did it originally cost when we bought it? How long are we going to keep it? In this case, it's 10 years. And when we're done with it, can we scrap it and get anything out of it? A lot of times that's going to be 0. But I threw it in just because I wanted you to see how that would come into play. What we're really saying is that we are not going to fully use this machinery up. There's going to be a little value left to it when we're done with it at the end of the 10 years. So we're going to use up $220,000 of this machine. See where I'm going with that? What it cost and what we get out of it at the end, the difference is $220,000. And we're going to do that over 10 years. Straight line method said, simple enough. Let's do 1/10 of that amount of money every year. So straight line would say take the $220,000 and take 1/10 of it every year. I'm going to run you back here. So straight line has a simple formula to it. And instead of actually working it, we're just going to talk about what the formula is. Take the cost and minus out any salvage value. Like I said, it's not uncommon for that to be 0. And take that whole thing, put parentheses around it to be a nice algebra problem to make it very clear, and divide it by the life. The number of years you're going to keep the asset. And that will give you the depreciation for the year. Straight line does the same amount of depreciation every year. So once you do that math calculation, you say the depreciation for each of the 10 years is this amount per year. There's another method that it asks you to do. Again, contrasting. Just like we contrasted FIFO and LIFO, we're going to contrast depreciation methods. Double declining is another method, and this is an accelerated method. That means it takes big depreciation I like to leave out letters. In the early years, small in later years. So there's not going to be that consistency. Straight line was the same amount every year. Double declining takes successively smaller amounts of depreciation every year. The formula is going to look a little complicated and weird. Bear with me. It's not as bad as it looks when staring at it. And pull that dash in there. Okay, to get 1 year's depreciation, you have to go through that whole formula. Then you have to go through the formula again the next year to calculate the next year's depreciation, because each year's number is going to be different. That's one of the annoying parts. But again, setting it up in Excel, and it can just take care of it. Or problems, software like QuickBooks, You can go in, tell it about the asset, basically give it what you were given in the story problem. What did you buy it for? How long are you going to keep it? And then go through a menu of which depreciation method would you like me to apply, and QuickBooks will take care of the rest.
With depreciation, there's supposed to be like a check or balance thing at the end, is there not? Like once you get to the 10th year, it should equal 0 unless you use some sort of salvage.
Right. So for our straight line depreciation, if we take that amount of money every year for 10 years, we will have knocked the value down to equaling the salvage value by the end of the 10th year.
Okay. Does that work for double in some of the year's digits?
Double, you actually have to watch yourself and stop when you have reached salvage value. So it's more of, like you said, a self-check.
Gotcha.
Watching your totals. Straight line by design just allows you to get right down to the salvage value evenly spread over 10 years.
So if I have a large piece of equipment or any piece of equipment I've never used before, it's something new to my company, I just make up how many years I think it's going to last.
Yes, except for the IRS, they have their own rules, and you can do 2 different depreciations. One that you record on your taxes, and the other you record on your balance sheets and other financial statements. For the balance sheet, you have a couple of limits, but they're like 40 years. So more than likely, they're not a limit you're going to have to mess with. You're just going to want to be reasonable for what is practical for you to use that asset. And there's some motivations on the part of the manager not wanting to stretch it out too many years, because you don't want to take a huge hit on depreciation because it's an expense. It's going to show up on your income statement. It's going to hurt your profits. So there's some motivation to never show it or to show as little as possible. But by the same token, if you don't depreciate it down quickly enough, then when you go to sell the asset and the books still say it's worth a whole lot and you get a tiny little bit out of it when you sell it, you're going to show this massive loss.
So once it's fully depreciated, then you can sell it for really what the value of it is.
Yes.
To account
for have a gain. Sometimes, like a building, we depreciate it even though it actually may be appreciating. The building is wearing and tearing and becoming worn, but it's real estate. And just the nature of the real estate may take it up in value. But we look at it as taking what we spent for the building and showing that as one of the costs of doing business. So every year that we were using that building, we're going to take a piece of what we wrote that check for when we bought it and apply it to that year as one of the expenses.
Okay.
So we're saying this big expenditure for this, in this case, $250,000 piece of machinery, going to benefit us for 10 years. We're going to want to show on each one of those income statements a piece of that machinery.
Okay.
One of the costs. So in this one, we're going to put the cost, $250,000. In the first year, the accumulated depreciation will be 0. There won't have been any prior depreciation that has piled up or accumulated. So the first year, we'll work that through that one, and you can kind of keep seeing where it would go after that. Would be $250,000 minus no accumulated depreciation times 2 times, and then you get the straight line rate. Straight line rate is what percentage rate does straight line take every year. Because we have a 10-year life, our rate is 10%. If we had a 4-year life, then the straight line rate would be 25%. The straight line would take 1/4 of it away every year. A 5-year life would equal 20%. That kind of making sense? Thinking about it as a fraction. Straight line, we divided by 10 and took 1/10 of the asset away every year. 1/10 is the same as 10%. A 4-year life would take 1/4 of the asset's value away every year, or 25%. Another way to look at it is 100% divided by the number of years. Going to come out to the same number. 4-year life, 100% divided by 4. You're going to get 25%. So you can always find the straight line rates by looking at the life. So in this first year, we're going to take 250,000 and times it by 20%, double the straight line rate. So the first year's depreciation is going to be 50,000. Just working out the math that we have there. The second year is going to be 250,000 minus the depreciation that's been taken so far. Now we do have some. The rest of the equation is exactly the same. The only number that's going to change is this one right here. How much depreciation has piled up to this point. Making sense, or feeling a little shaky on it?
I feel like it makes sense. I'm maybe a little shaky just because I don't look at numbers a ton, but yeah, that it makes sense in my head.
So this year, when we do the subtractions here in the parentheses, we're at 200,000. 250 minus 50, 200. 200 minus or times 20%. Going to have a smaller depreciation. We're taking 20% still, just like we took 20% up here, but 20% of a smaller amount. It was 250 here. Now the parentheses are only 200. Another way to look at the parentheses is they represent the book value. That's what you call what's in the parentheses.
Okay, Donna, I do have a quick question. It's kind of going back to that straight line method.
Sure.
Now, it's going back to the group assignment. Now, the straight line is cost minus salvage value over life. But what if there is no salvage value?
Then it's just cost divided by the number of years.
Oh, that's simple, huh?
Yep. You can keep using this formula. Just put cost minus 0, because you have no salvage.
Got it.
Divided by how many years.
Okay. Gotcha. Okay.
I wanted to take this one step further just because I wanted you to see something. And you've got 10 years to do, so I figure I'm still leaving you plenty to do and not doing your homework for you. The second year's of 40,000. So you can see it's going down. This is where most students make the mistake. That's why I'm trying to go here. This time, again, the cost has not changed. It's what we paid for it when we bought it. But it's the accumulated depreciation. How much depreciation has piled up at this point?
90,000, right?
Right. And a lot of students grab the prior amount. We want all that has accumulated. Okay, and so then that number every single time is just going to get bigger and bigger and bigger because it's going to be piling up. But your depreciation amount each year should get smaller and smaller. Okay, you may not end up doing all 10 years. Because remember, all we want to do is take this asset from 250,000 down to 30,000. So we want to take $220,000 of depreciation. If after, let's say, 7 years, we've already taken 219, Then in the 8th year, take just 1,000 depreciation, just enough to get you to the limit. So even if the formula says take a whole lot more, you need to put the brakes on and stop when it reaches that level. You have one more method, and hopefully you're hanging on to the fact that there is no test in this course. So no one's going to ask you to repeat these things or close your book and regurgitate all these formulas. But when the accountant comes to you at work and asks you as the manager, pick a method, I want you to understand what they're talking about. I want you to speak their language, understand the ramifications of choosing one over the other. Sum of the year's digits is another accelerated method. It's going to be bigger amounts in the earlier years. And its weird title comes from you literally take all the numbers leading up to how many years this asset's life is. So it has a 10-year life. The math problem, and I'm not going to let Excel total it up, I'm just going to show it so it stays as a problem. You actually add up all the years. If this had been a 15-year life, I would have gone from 1 to 15 and added all those up. That equals 55. We are going to make fractions out of each one of those. So in the first year, the first year's depreciation, you're going to take something that looks pretty familiar. Remember that? We did it with a straight line. Cost minus salvage value. And you're going to times it by a fraction. Sorry, 10/55. You're going to take the number of years left to go and make it a fraction over top of the total of all the years. The second year, you're going to take this exact same set of parentheses, same numbers, copy them instead of dragging them. And this time, multiply it by 9/55. And you're going to do that every year until you get down to 1/55 in the very last year. Our cost is what we paid for it. Our salvage value is given in the problem, and those numbers are not going to change. So this parenthesis is going to be the same number, but it's multiplied by smaller fractions every year. You don't have to watch the limit. Just by doing the formula right, all your years of depreciation should add up to $220,000. That's a good double check. When you're done with all 10 years, you should have reached the $220,000 depreciation limit. You doing okay with time? I know I'm taking a lot of your time.
I'm good.
Tristan, I know your boys are trying to be patient. Are you doing okay?
Yeah, they're upstairs. Maybe you could hear them bouncing. They're taking it back. They're fine.
No, I'm not worried about hearing them. I'm just worried about you guys with time. Trying to balance how much to cover so that you feel like you're really prepared, but also going, okay, they don't have all the time in the world. I'm sure they've got schedules. So if you have to bow out, I understand. I'm going to keep this thing recorded, and if it turns out too long, I'll put it in 2 recordings. That kind of takes care of question 6, which is all about the depreciation. Question 7 asks you about retained earnings. Retained earnings is actually a pretty simple account to keep track of, and this is something that's going to help you in the group project too. Retained earnings, we talked about when we were first learning what it was. All the profits go in. So we plus the profits, and we take away the dividends. It's going to tell you how much they paid out in dividends, how much their profits were, and you've got to find out what's left in retained earnings. So let's say add and subtract, find the balance. You have only 2 questions left to go in the homework after that, and they both depend on you understanding an income statement. So we're going to take a couple minutes to talk about an income statement before you can actually do the homework on it. So an income statement, in contrast to a balance sheet, covers a period of time. It'll say, this is a report of everything that happened during the year of, the month of. So we're stretching over a period of time. And it's looking at our revenues and our expenses. A real quickie definition of revenue is, depending on what the company does, if they do work for clients, if they're a service business, it represents the work done. If they sell products, then it's the amount of products sold. Expenses are what we used up in order to make the revenue. So they're things we used up. Revenue sometimes is called sales. So don't be surprised if sometimes you see no revenue listed on the income statement if it's replaced with the word sales. It means the same thing. There are lots of different kinds of expenses. One of the biggest being the cost of goods sold. And you looked at that already when we were trying to decide the cost of the 900 products that we sold, the 5-box diagram. We figured out what our original cost was for those 900. We did it once with LIFO and once with FIFO. But that's a big expense. Just like our kids with the snack stand. If they sold snacks at $1 a piece, their sales would be how many ever they sold times $1. Their cost of goods sold, or one of their biggest expenses, would be that same number of products sold at 60 cents a piece because that was their original cost. Generally, and I think it's page 56 in your book, shows an income statement in chapter 2, and you'll see that they subtotal after cost of goods sold. So often a subtotal called gross margin or gross profit. Again, interchangeable terms. So they're going to list all their expenses, but they may very well show revenue, then just one expense, cost of goods sold, and then do a subtotal. As we get into more analysis of financial statements and how this company is doing better than that company, gross profit is something that a lot of companies like to look at. So they like to have that subtotal before they go on and show the other expenses. Then the rest of the expenses. And they'll list them. They may categorize them like, here's my selling expenses. Or they may literally list each type of expense. Advertising, commissions for the salespeople, and so on. And then gross profit minus the rest of the expenses. And you'll equal net income. Officially, net income before taxes. Only corporations pay taxes. So if this had been a sole proprietorship or a partnership, that would have been the final number on the income statement. If you're a corporation, it's a subtotal. Then you show the taxes, and then you can say net income after taxes. Taxes are usually shown as some percent, and I think the book's been pretty consistent. It's like 40%, 30, 40%. Let's call it 30 to 40% of the net income. So they come down to the subtotal. They say, this is my profit. Oh, yeah, but then I've got to pay taxes on it. So they report 30 or 40% of it, and after is those 60 to 70% left over. It's not uncommon for the company to report earnings per share, which just says take that net income and figure out if there's 100,000 shares of stock, what each share of stock's share of that value is. So you're always dividing the profits by the number of shares. Your homework has you looking at an income statement. They give you some of these amounts and make you work forward and backward to fill in the missing amounts. But you weren't, in essence, making an income statement. You made income statements in your homework. Sorry, wrong class. Too many classes going on. The finance class just made a couple of income statements also. And your last question is to compute the earnings per share. So questions 8 and 9 all hinge on understanding the income statement. For your group project, you're taking just sentences about a company, just little hints, and reading them. They're in random order and making a balance sheet and an income statement. Your balance sheet and income statement may include a few assets or expenses, liabilities that you didn't have in the textbook, and it may not include everyone the textbook has. So you have to be a little flexible with what's there. If you have any trouble, if your group wants to put together a draft and send it to me and say, this is how far we got, but things aren't looking good, they're not balanced, and I think it's supposed to be something different, where did we go wrong? I'd be happy to look at it and send it back to you. Okay?
Cool.
Any specific questions you're just really hoping I would cover in tonight's meeting?
I think all my questions were covered. I really appreciate the help up front, because now that I understand a little bit more, I think I can get through these pretty quickly.
It's all laying a foundation. And you can feel kind of shaky and just think, oh, it'll clear up as time goes on, but you can't build on a shaky foundation, because pretty soon it's all going to come tumbling down. So we want to make sure the foundation's good, and then you just keep building on it.
Thank you.
You're welcome. Tristan, doing okay?
Yeah,
Raquel?
Yep, I'm doing great, thank you. Again, thank you for your time tonight. I do have questions, though, as far as when I look at the syllabus, I'm looking for due date. Now, the voice threads always do the third night.
Right.
Is that the discussion now?
That's just the,
and then, like, the
exact same question.
I'm sorry?
Yeah, the discussions were supposed to be a certain question, and I kept the questions the same. You're just not responding by recording your voice. You're responding by typing. The technology just wasn't working. They were trying, and finally the people that I went to threw up their hands and said, why don't we try it the next time there's an online 525 class? That'll give us time to fix that, and we'll just go with the traditional type out your answer kind of discussion forum this time around.
So we're not using
No, the discussion thread's just been replaced by the typing out your answer.
Okay.
And, the rest of the things are due at the last day of the week, midnight, And I got to say, I'm not one to check the timestamp.
Is that Monday or Tuesday? Sorry.
I believe your class is a Tuesday-based class. So
it's due Monday at midnight.
Right.
Okay.
And if it's there when I look at it Tuesday morning, I'm happy. So don't worry about 12:01. There's nothing going to happen. If I go into grade and you don't have a submission, that's when, I'll probably end up putting a 0 in the grade book. They really encourage us to put something in the grade book, because otherwise a student who maybe turns in 1 out of 10 assignments but does excellent on that 1 out of 10, the grade book in Moodle is going to show them at 100% or some excellent number, because it doesn't average anything that's blank. So I go in and put a 0. That way it's a more accurate reflection of their score. If it's something that's come up where you've emailed it to me because you couldn't get the link to work and I didn't see it and I put a 0 in, it's no problem. I can go to my inbox, find it, go change your grade in Moodle. So don't freak if you see a 0 and you think you submitted something. Just point it out to me and we'll figure out what went wrong. Does that make sense?
Okay, so the turn it in assignments you say are due on the last Monday night, right?
Yes. And your group assignment, just work together as your group, and one person submit it with everybody's names on it, but only those who participated.
Gotcha.
So Tom, Dick, and Harry are in a group together, and one of them doesn't even come to the meetings, doesn't give any effort. Don't put his name on the submission, because I'm not psychic. I can't look at the final product and know who did it. I want to be able to give the credit to those who really participated. If you're
that makes sense,
and you get this ebb and flow and everybody's participating, but some weeks this person does a little more and another week somebody else does, but it balances out, then just keep putting all the names on. I had a gentleman last time whose wife had a baby. So obviously he missed a week with the group. He tried his best, and I think he was still kind of helping, but they all covered him that week. But they'd been together through almost their whole cohort. So he'd built a relationship with them, and they knew that he's not a slacker. He's just going through life. So I'll let you balance that out, but feel free to let me know if someone's not participating, even if you have to do it through an email because you're not the one submitting it that week. That makes sense?
My last question.
Yes.
Yep, it does. My last question is about the final project. Are you going to be giving more direction with that, or just what we have?
I will go through more with you. It's kind of hard because you need to be incorporating so many of the things we're doing, and most of the things we're going to be doing are in the next book. So if I sat here and named them all right now, you'd be looking at me like, okay, I'm just to include these things. I don't even know what those words mean. What we're looking for is for you to tackle some accounting topic, maybe a problem work. Some people have a great work situation where the things we're learning fit right with what they're doing at work, and they can look at a scenario. One person ran the numbers of outsourcing versus continuing to do it in-house. And she used a lot of the analysis tools that we were doing to incorporate making a decision. So it could be a decision-making thing like that. Some people do what if I started my own business? And they went through the whole plan. What's it going to cost? What am I going to have to charge my customers? How many customers am I going to have to make this thing profitable? And is that reasonable? Can I really get that many customers? And really ran through all the expenses and researched, okay, what's real estate cost? Guy in my last class wanted to do a knitting coffee shop. His wife's into knitting, and they were going to open like a cafe where you could come and knit and buy coffee, and they could rent out rooms and have coffee clubs and knitting clubs and so on. So he looked at real estate. What does it cost to get a building or rent a building in that area? Really taking it out and seeing numbers in it. It ought to be very number oriented. Does that help?
Yes, ma'am, it does. Thank you.
Just going to get thinking. I am not looking for you to lock into an idea in a certain week and say, in week 4, you must submit your final decision on what you're going to do. just keep bouncing ideas around with me. Some people are going to have their decision made by week 2. Others are going to take till week 9. I wouldn't recommend that, but at times the greatest idea strikes you at the last minute. Tristan, I was asking you earlier if you're doing okay.
Yeah, doing fine. I just had I did the homework, and the double declining balance method was a little different from what you explained today than what it is in the book. So I kind of got myself a little confused, but I think I can, once I review yours, I can figure it out again.
Okay. No problem. If you can't marry the two together, just let me know and I'll help you through that. I know the explanations are a little different, and sometimes that's good to have a second way to explain it, and sometimes that just leads to confusion. So.
And what is there a bad, is it like bad to use the one that was in the book where it's...
No, if it was just confusing, then,
It was more confusing to figure it out. I needed quite a few spreadsheets.
Okay. Use whichever one makes sense to you.
But for that one, should there be you said it could end in the 7th year that you hit your depreciation with your salvage.
I don't know the actual year, but I'm just saying it could end early.
Right, it could happen.
Okay.
So there should be a 0. I don't know. I don't know what I'm trying to say. Never mind.
That's okay. If you want to put them together, email me that problem and I can look through it and say, yeah, you're on the right track, or here's where you went wrong.
Okay.
Okay.
Thank you.
You're welcome. Don't feel like you're out there alone. Okay, well, I'm going to hit stop on the recording and try to get this uploaded tonight. It takes a little while for the file to save and then re-upload because as a video, it's an intense file size. There'll be a link to a YouTube channel. I didn't know Cornerstone had one until Connie in our class, who's also the Moodle guru, showed me that. So what you will find in an announcement email will be the link to the video that won't actually be in Moodle. It'll be in YouTube. And then I will send out the Excel spreadsheet. Okay?
All right.
Thank you.
Thanks.
Have a good night.
You too.
Night.
Bye-bye.
Thank you. Bye.